Okie dokie, picking up on our last video, we have, what are we talking about? We're talking about merchandising concerns and the accounting nuances for merchandising concerns, and we're talking about two of them. The first is inventory. As soon as we talk about manufacturing companies, we're talking about the reality of inventory. And in conjunction with that, we're also talking about on the balance sheet, it's inventory, and on the P&L, profit and loss statement, income statement, we're going to be talking about the reality of cost of goods sold. These are two sides of the same coin. Actually, let's just pretend, you see if we can get an illustration here. Let's just say here's a little bucket, and let's say this right here represents our inventory. So this is what we start with in the beginning of a month, let's say, or beginning of a year. This is our beginning inventory. Whatever that might be, those are sneakers, let's say. We have that much inventory, and then during the year we purchase this amount right here. We add that to the beginning inventory. These are our purchases, or our additions. These are our additions to inventory. And these two pieces together then represent what we have available for sale. You walk into the store and say, what do you guys have available for sale? We would point you to both of those pieces. This is available for sale. And then we realize that we sell some, right? So I'm going to sell some by erasing them. Let's say we sell this. We sell that much all the way to the edge. Let's just say we've sold some of the stuff that we purchased, and we also sold some of that beginning inventory. And that blank space right there represents what we've sold. So let's show that as sold. This thing right here represents, this space right in here represents what we have sold. So what would we have for our ending inventory? We would have this piece left, this blue piece, plus this yellow piece. So those two together right here, that right there, would be our ending inventory. So we've got different pieces when we're talking about inventory. And you notice that this sold piece right here, that is cost of goods sold. So that's why I say that for merchandising concerns, the inventory and the cost of goods sold, they're kind of two sides of the same coin. To address one is to address the other. And you can see how we addressed one, inventory, here. And by addressing inventory, starting out with a certain amount of inventory, and to that we add stuff, we purchase stuff. That gives us a total available for sale. And then we say, well, we're not just buying stuff and accumulating it on our shelves, we're actually selling it. So we visually showed what we sold as that space right there. Maybe we should put a couple go like this and say, this is what we actually sold, this stuff right here, to give us what we have at the end of the year. And the blue circle represents our ending inventory. And the reality of what we sold is that it shows over here in our P&L. And we could even show this, instead of in a picture form, we could say our beginning inventory plus what we purchase. And that's actually net purchases, because there's purchases discount, purchases returns, and allowance, which we'll see in the chapter. But beginning inventory plus purchasing activity, let's say, equals our cost of goods available for sale. That was this red, available for sale. We subtract out our ending inventory, and that will give us our cost of goods sold. So again, the inventory, the realities of what's going on in the inventory are impacting the cost of goods sold. And here's just let's say we have beginning inventory of $10,000, and we add purchases of $2,000. That's going to give us what? $12,000 available to sell. And let's say that we've determined that the ending inventory is $5,000. We started with $10,000, we ended with $5,000. What was the cost of goods sold? The cost of goods sold is the difference between the 12 and the 5, which is $7,000. Now, question, where is this cost of goods sold going to show up? The answer is in the income statement. That's where it's going to show up. In effect, let's go to our equation. Assets equals liabilities plus owner's equity. So we know that our cost of goods sold is $7,000. That's going to be impacting our owner's equity, right? Through the P&L, which we've talked about in prior chapters. And this ending inventory of $5,000, where's that going to show up? That's going to show up as an asset. Our ending inventory is going to show up. It used to be $10,000, and now it's $5,000. So that's going to show up in the asset classification. The cost of goods sold is going to impact the balance sheet through the income statement, specifically in owner's equity. So this is how the inventory and the cost of goods sold. I wanted to show it in a picture form, just so you can get an image of what's going on. Here it is in dollars and cents, but sometimes it's just helpful to see a picture of this. What we're going to see in the next video is that there's two different ways of reporting for this inventory, because inventory is big, right? And what we do with inventory matters a lot. So there's two ways of accounting for inventory, and it depends on whether we're using a perpetual system or a periodic system. Accounting system, that is. Are we using a perpetual system for inventory or a periodic? Perpetual means that every time there's a transaction that involves inventory, that we are going to be accounting for it by updating the inventory account and the cost of goods sold. So when we add inventory, we're going to be showing that into an account called inventory, and we're going to be adding and subtracting the inventory account itself. And when we sell things, we're going to be picking up cost of goods sold, because the issues are going to be surrounding these two things. How do we handle the inventory? How do we handle cost of goods sold? Do we directly post to inventory? Do we directly post to cost of goods sold? Or do we indirectly impact inventory and indirectly impact cost of goods sold? That'll hopefully make more sense in the next video. But think of it this way. Perpetual means it's real time. Periodic means it's once in a while. At the end of an accounting period, we would actually physically go take an inventory count. And based on that inventory count, we would come up with a calculation of cost of goods sold. It doesn't matter which system we're using, whether it's perpetual or periodic, we're going to come up with the same numbers for ending inventory and cost of goods sold, the same figures. It's just a question of how we go about getting there. So let me pick that up in the next video.